This is shocking. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, this major economic powerhouse is crashing at the fastest rate since the global financial crisis. Now, if you're wondering what we're doing in Stuttgart, Germany, inside the Mercedes-Benz factory, well, it's not because we're shopping for a new car. It's because things in Germany have taken a turn for the worse. But before we get to that, we have to head back to China real quick because what's going on there got much worse over the weekend in a sign that the global economy is about to make another big turn to the downside. And here we can see from Bloomberg, China urges more loans, debt risk reduction, as well as compound. Now, if there's one headline that we can ever see here that finally starts to make some sense, that gives us some indication that policymakers might actually get what we need to see for the global economy to get pulled out of the slump, and that is we need more loans. Because that, again, we talk about how the global economy works. We need new money created from the global commercial banks to inject money into the economy at a rate fast enough, not only to sustain and create growth, but to pay on this mountain of debt that not only we created in all the decades before, but the ton of it we created during the pandemic. So at least from the onset of this, we get that maybe Chinese authorities get it, but hang tight, they don't entirely get it. Authorities also urged for adjustments and an optimization in policies for home mortgages at the meeting on Friday, according to a statement from the People's Bank of China, then on Sunday, without elaborating on the housing initiatives. And you can almost imagine what was happening at the meeting. It was nothing more than a strong arm effect of, hey, you need to go out there and lend because we're not going to give you a whole lot of latitude and sort of from policy support on this deal. And sure enough, that's what happened. China has repeatedly urged its banks to increase lending to support the economy. Now, can you imagine that? You know, the government going to the bank say, hey, look, you need to get out there and you just need to lend more. Could you imagine having a business and just some regulator or some government authority come in and say, you know what, you just need to sell more of your product, do more of your services. Yeah, that seems like a great idea. I'm sure there isn't a business owner in the world that wouldn't love that to happen. But right now, the banks don't want to lend. It's all about the money curves. In July, Chinese lenders extended the smallest amount of monthly loans since 2009, a further sign of weak demand in the economy that raises the risk of prolonged deflation pressure. And this absolutely does, because when we start talking about, commercial industrial lending, we're going to look at the U.S. data here in a moment, because of course we don't have access to all the Chinese charts and data that we would love to have, but we're going to look at the U.S. and compare what's going on here, because when you start to see loan growth slow, particularly to levels that are, virtually unchanged from the year before and then face even contraction, the issue that starts to happen here is when bank lending enters a contraction, net on net, money is destroyed. So you think about it. If money is created when banks lend, well, what happens when it goes in reverse? Well, exactly, it's destroyed, and that's what leads to deflation and a downturn in the economy that not even a central bank can readily stop. And here we can see in this chart commercial industrial loans in blue, this on a year-over-year rate of change of all commercial banks against real gross domestic product. Again, we're looking at U.S. data here, and you can see the correlation. Now, is it perfect? No. Is it every time? No. Is it most of the time? Well, absolutely. And you can see a slowdown in lending leads to a slowdown in GDP growth. You can kind of see that over and over happening and again and again. And this is what's kind of challenging because, over the decades, you'll hear from presidents, right now we're hearing from President Joe Biden that Bidenomics is really the savior and it's going to be doing great things. And yet I kind of like to suggest to them, they're almost at the mercy of whatever the central bank is. When you become president, if you're in during the good times when central bankers are supporting the economy, keeping the curves, properly adjusted, it's not a problem. But you start looking at what's happening now and you hear all this talk about how the economy is going to boom. It doesn't matter who was in office because in reality, commercial industrial lending is at 1.7% year-on-year growth, as we talked about the other day, and is headed negative. And of course, if history has any guide of what's coming, that means GDP growth is going to turn to the downside, and what we're facing is a potential another contraction in GDP, which is very dangerous. The PBOC said last week they reduced a key interest rate by the most since 2020. At the time, it was a surprise move that came in shortly before the release of disappointing data for July, showing growth in the consumer spending, industrial output, and investment sliding across the board, and unemployment picked up. Now remember, we said last week that when a central bank starts to cut rates, it's usually not a good thing, particularly if there's more than one cut happening here. So in this case, China knew the data that was coming out was bad, and they wanted to soften the blow and say, hey, kind of look, we get it. We're going to support the economy a little bit. We're going to lower rates, and hopefully that will turn lending around. But the question then becomes is, does it actually make a difference? The answer, no. And here we come back to commercial industrial lending at all commercial banks is shown in blue on a year-on-year rate of change against the federal funds rate. So we'll use the U.S. data as a perfect example of why Chinese policymakers, we started out the show saying, look, I think they get it, but not quite. Well, here's where you can see is, the Fed's cutting rates, and what happens? You still see lending continue to decline. In fact, you'll almost notice they start to go together. The Fed's cutting, lending growth is slowing or outright contracting when it's below the black line. Here again, Fed cutting, lending actually slowing, then contracting, again, contraction, and then a little slowdown here going into the pandemic. Of course, we know the government came in and supported the forced loan lending out there, and then here we see it again. The Fed hasn't even started cutting, and we're going to see a contraction here. Normally, what happens is the Fed's already cutting into a slowdown in lending. This time they're way behind the curve, but the idea that it's a little bit of a cut here or a cut there is actually good for lending, not at all. It actually is a sign that the economy is slowing down and going in the wrong direction, and that's where Chinese policymakers just don't seem to get it. Major financial institutions, especially big state-owned banks, must increase loan disbursements and avoid big fluctuations in lending, according to the PBOC statement on Sunday. Yeah, can you imagine this? Having a regulator come into your bill office and say, hey, wait a minute, you need to do some more lending here because you really don't want fluctuations in the data now, do you? Now, who doesn't want it? Well, of course, China doesn't want it. Beijing, they don't want to publish these numbers. They look at these wild fluctuations because what they're trying to suggest to people is, look, just because there's a downturn this month, there may be a huge month next month. The reality is what they're trying to do is get the banks to lend, get money out in the economy, get people spending it, because that is what makes a debt-based economy works, is the expansion of debt, and China needs a whole lot more of it at a time they too are massively indebted. Regulators and financial institutions should coordinate and reduce risk associated with local government debt and strengthen such monitoring, the central bank said, sounding like they have no clue what they're doing. And this turns to China's surprise move then on loan rates, shows banks are under pressure as lower lending rates would hurt profitability at banks, and they're really concerned about that. But one thing you shouldn't be having a problem with profitability is that's your trading account, because this came from a subscriber. He says, Steve, I was watching the show. You're talking about how things were going bad in China. I pulled up FXI, the ETF, the China ETF. I said, is there an opportunity here to hack your CTA-Timer Pro report to the short side? And he waited until the machines showed their first selling indicator right here, took a short position. As of today, I wanted you to update that trade would be up a whopping 13.5%, and all very simple. He had access to the report and is getting, and we talked about this on Sunday, that the global CTAs were going to sell more. Here you can see that very first indicator on July 10th. There you see it. The machine's going from long and backing off their long positions. That's where he took the trade. And of course, you can too. All you got to do is sign up. There's a link in the description. It's $30 a month, $1 a day. One trade pays for the whole thing for a year. And twice a week, we put out a list for you to keep an eye on of what we think are the biggest opportunities that following in the report. Now let's get back to China here, because we still need to get over to Germany and see what's going on there, because all of these things are linked together in this global economy. as Chinese banks kept a key interest rate that guides mortgages on hold and made smaller than expected cut to another rate, a surprise move that reflects Beijing's difficult choice between boosting confidence and safeguarding the bank's safety stability. And I think this is kind of a nod to kind of what happened here in the U.S. earlier this year and what is likely going to happen again. At some point, we're going to see the small, mid-sized regional banks just outright blow up. We know based on the data from Friday, they're still tapping their Fed credit line in even a bigger way, as every week they're drawing more and more money down. And what do we see from China here saying, look, you know what? Maybe we don't want to go down the same path as the U.S. because we're already facing what is going to be another banking crisis out of the U.S. We really don't need one here. So they're trying to turn and focus on making sure the banks stay healthy, but that may not matter much at all. And what they did is they lowered their one-year LPR rate by 10 basis points, a smaller cut than most expected. It was hardly anything, and they left their 5-year loan prime rate at 4.2%. So you get kind of the idea here. They went and strong-armed the banks and kind of threatened them. You need to go lend, and the banks are like, well, okay, and what are you going to give us? Well, you gave us virtually nothing, as if, you know, a 10 basis point cut was all it's going to take to get a whole line of people at the bank and lend. I don't think that's going to make a difference at all. And protecting the bank's net interest margins is the main motivation behind the smaller than expected cuts to the LPR in our view. This from Goldman. Having said that, confidence remains a key to an economic recovery, and boy does it ever. And the disappointing cut to LPR would not help with building confidence, and they got that right. Here you can see the University of Michigan Consumer Sentiment Survey against the federal funds rate. Again, let's take a look at the U.S. data and see what happens when central banks cut, because if my opinion here is correct that a central bank cutting rates is not good, then what we should see that at some level is be backed up with consumers finding it less confident as well, because if consumers bought into the Fed cutting rates, well, anytime they cut, well, we should see confidence just drive higher. Well, we don't see that at all. We see the consumers get it perfectly. Here you can see the federal funds rate declining through the late 80s into the early 90s. And look what happened. Consumer sentiment came crashing down during the recession. We see it again during the dot-com bubble. The Fed starts to cut rates, and there goes the confidence in the economy and everything else that was blowing up. And it only got worse the third time around. Here the Fed starts cutting rates. Everyone says, oh my gosh, this thing is going to go nuclear. It did. Global financial crisis. The Fed was cutting into the pandemic. Now, that actually, there was confidence, but of course that eroded real quick. We can't count that one. But here we can see it again. The Fed's looking at potentially, we see later this year, cutting rates likely as the economy slows. Confidence not really all that high here to begin with. If this rolls over and heads down, well, it tells us where spending is going next. The government signaled more urgency in shoring up growth for the world's second largest economy as borrowing demand slumps, deflation pressures take hold, and confidence struggles to recover. Investors are also concerned about contagion risk following a liquidity crisis at a major shadow bank. And they should be, because this is exactly what happens during deflationary money events. We see this in the yield curves. These inversions are real. They have real repercussions in the economy, and it just maybe not a great timing mechanism, but over time, the yield curves make a huge difference here, and it leads to, of course, deflationary events, slowdown in lending, and then, of course, the risk of contagion. What's going on in China is absolutely real. It was just like in the U.S. when one bank failed, next thing you know, there's 2 and 3, and an all-out panic by all the regulators, put some Band-Aids on the system and hope it actually works, even though we're seeing that there's still a lot of these banks that are bleeding, just not nearly as much. China's worried about it. We know there's no way they're going to escape this without things getting worse much sooner. Chinese banks have faced narrow profit margins in recent years due to fiercer competition and a decline in lending rates since the pandemic. Wow, again, here we have a sign that maybe somebody gets it, and there it is. Lower lending rates are not good for the banks. That from the PBOC in a special section of his quarterly report. Banks need to maintain reasonable profits and net interest margins so they can serve the real economy and prevent financial risk. But one of the challenges, and we see this right now in the U.S. real estate sector, is people don't want to sell their home. They might want to move, but they don't want to sell their home because they don't want to give up that really preferred low interest rate that they have to go to a higher one. And so that's one of the challenges of a debt-based financial system, particularly a global version of it, because you need perpetually lower and lower interest rates to get consumers eager to spend. The question we all have is, where do you go after zero? And here you can see commercial industrial loans. Now let's get the yield curve in play here, because now we can see this is a 10-year, 2-year, where you take 10-year yields, subtract the 2-year, and when it's negative, it's under this horizontal black line, and lo and behold, what do we see? An inversion leads to a slowdown in lending. Further inversion, another slowdown in lending. Here you can see in the 80s, there's for the real reason you had inversion, because banks don't make money if they're borrowing at the short end of the curve and lending at the long end of the curve. This means there's no profit in lending for them. Maybe they make it in fees and other things, but there's just not the profit. Again, slowdown and ultimate contraction in lending. Here you see it again in the dot-com bubble. Just a minor, fairly minor inversion here going into the global financial crisis was absolutely enough to slow down that overheated economy and sending commercial industrial loan rates going negative. We saw it, slow down here going into the pandemic, and then now we're seeing that major slowdown. It's going to contract, it's going to chew money up out of the system, and it's going to lead to stock market going down. And that's why you see, Beijing step in now and say, hey, we need support under our equity market because Steve's CTA program is saying you should short it. As China's stock rout sparks 119 million buying pledged by funds, which seems not enough. Such pledges by mutual funds have been a common feature during stock market slumps, also seen at the start of 2022 and during the pandemic sell-off during the early 2020. But the buying may do little to move the needle this time around, as investors say the market suffers from a lack of confidence when no clear catalyst in sight. And boy, do they have that right, because when we take the University of Michigan Consumer Sentiment Survey and overlay the Wilshire 5000, this is a total U.S. stock market, lo and behold, when confidence goes down, the market goes down. And you see that here again during the global financial crisis. That was an obvious one. But look at this around 2011. Confidence comes tumbling down. Market goes with it. Here you can see again, confidence down, market down, and now market's up. We know confidence follows that. But what if confidence starts to roll over here as the economy slows and layoffs pick up? Well, you can better believe stock market's coming down with it. And here we get to our lead story, because now here we are in Germany as producer prices post a first fall since late 2020. Now this makes a huge difference, because when we talk about a major economy getting crushed, Germany is maybe the second biggest problem here outside of China. Of course, that means if China's going down, Germany's going down. If you think the U.S. is going to escape this, not a chance. But remember, the narrative now is inflation here in the U.S. is going to make a resurgence, but here in Germany, not a chance at all. Check this out. July producer prices were down 6% compared with the same month last year. That is deflationary in the producer price space, when producer prices soared as a consequence of the war in Ukraine, according to the Federal Statistics Office today. It was the first year-on-year decline in producer pricing since November 20, and get this, the sharpest decline since October 2009 during the financial crisis, suggesting that, of course, Germany is facing a financial crisis. With energy prices excluded, producer prices in July were 2% higher compared with the same month last year. Obviously, as we've said, energy matters in a big way. Let's check out these charts. Because if the same thing were to happen in the U.S., here we have producer price index by commodity in final demand in blue against the consumer price index in red. You can see the beautiful relationship here, suggesting that the CPI should come down even further. And if we see, again, much more declines in the producer price index and go negative, well, that means, of course, consumer prices are coming way below the Fed's 2% target. And does all this have a matter to do with energy? You bet. Here we have U.S. regular all formations gas price. That's shown in blue against the consumer price index, still shown in red. And kind of the recent move here, as we see the year-on-year rate of gas prices popped up a bit, giving everyone some excitement that perhaps indeed this means inflation is coming back in a big way. But these moves can be very short-term and may not have a big magnification into, of course, the consumer price index. As we can see here, if Morgan Stanley says if China enters a debt deflation loop, it will spread disinflation around the world. And that's a case that we've been making here for a while, that just because, there's some pockets of the data that might show a little bit of resurgence, we're in a global economy, and China is a big factor here. When they export deflation, and this is a problem. And late last year, we were bullish on China's growth prospects, but warned that the spillovers to the rest of the world would be limited. The reverse is not true. If China slips into a debt deflation loop, it would be a disinflationary force for the rest of the world via trade, commodity prices, and currency movements. Weakening in investment would hurt demand for exports from China's key trading partners, with Asia and Europe, there you have it, Germany most exposed, and China's exports of manufactured goods that's going to the U.S., especially if accompanied by significant currency depreciation, would spread disinflation globally. And there you have it, because we're going to look at their currency here in a moment, and it'll all make perfect sense. And here you can see, of course, producer prices. This coming out of China against the U.S. Consumer Price Index. Beautiful relationship here. China is in deflation right now. Again, exporting deflation and likely to export more of it, suggesting that even if gas prices pop a little bit, there's going to be enough deflationary forces pushing the CPI even lower in the months to come. And China seeks Goldilocks yuan to support liquidity. Of course they do, because they've begun to push back more forcefully on yuan weakness versus the dollar, trying to keep it from going down. Of course, as more it drops, the more deflation they're going to export. But some level of currency devaluation is required in order to keep liquidity supported. They signal their intention to further limit the U.S. dollar CNY upside by setting the fixed rate much lower than expected. Indeed, the fixing was the lowest it has ever been in relation to the fixing survey estimate in its 5-year history. But what does all of this mean? Well, let's take a look at lending against the dollar, because what China really needs right now is the dollar to cool off a little bit. Nobody really thinks that, but you think about this. If we're not creating new money, then the idea would be the existing money might be worth more. Not necessarily. If there isn't demand for currency, it goes down. And sure enough, you can see it right here. And commercial industrial loans at all commercial banks, this is still on year-over-year rate of change against the nominal U.S. broad dollar index. Sure enough, we see slowdowns in lending and eventually lead to a contraction. The value of the dollar declines because demand for dollars is going down. You see that slowdown here in 2015 led to the dollar getting weaker as well. You can see that happening post-pandemic here. And then now you're seeing the dollar. Everyone thinks it's going a lot higher. China needs to go down. Well, at this rate, because of commercial industrial lending slowdown, what it tells us, the dollar's going down too, and all that means is the U.S. economy is going to be mired in its own problems, another banking crisis and deflation. With that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.